Good morning and welcome. You may recall just before the 2012 Olympics, Mario Draghi announced that the ECB would do whatever it takes to save the euro currency. At the time, Ireland couldn't borrow for 100 days. Last year, we could borrow for 100 years. Indeed, in 2021, for shorter term issued government debt, the Irish state was being paid by investors when it lent money. Happily, the responsible public servants at the NTM&A have positioned the country so there is no extraordinary borrowing need for the rest of 2022. Today, we are far from being in the club known as the PIIGS countries. Ireland Inc. sits among what is now known as the mid-core sovereign countries such as Netherlands and Belgium. Indeed, Ireland Inc. can borrow more cheaply than Belgium. A question you'll be asking our presenters this morning, Richard Timperley and Brendan Tuig, is, has it all gone horribly wrong? Any questions you may have, please put them in the chat box below or email either my colleague Owen or myself, or you can phone us. On Tuesday, we were presented with our budget. And you may be asking, is this budget akin to the giveaway budget of 1977? You may have seen the disturbing media reports this morning that my local TD, who's a fellow member of Chartered Accountants Ireland, and who should know about the SSAP 2 concept being the prudent concept, seemingly Mike McGrath is not ruling out dipping into the 6 billion National Reserve or rainy day fund. We are the three allegedly economic prudent political parties in government, the Greens, Fine Gael, and the seemingly political party of those of us who get up early in the morning, i.e. Fine Gael. You may ask in the chat box below, have they lost the run of themselves? Are the coalition parties overtly stealing the clothes of Sinn Féin, adopting Sinn Féin populist strategy to try and out Sinn Féin? I'm pleased to start this morning with Richard Timperley, Head of Investment Development at Zurich Life Dublin. Richard is a graduate of Trinity College Dublin and a qualified actuarist. He has extensive industry experience, having worked in investment as an investment analyst, stockbroker, and fund manager. Having joined Zurich in 1990, he's currently head of investment development. Zurich's investment team, based in Blackrock, County Dublin, responsible for funds and perhaps some of your savings for the management of approximately 31 billion euro. I hand you over to Richard.
Okay, thank you, Sean, and good morning, everybody. Yes, so as Sean said there, I'm a fund manager by trade. I've been working with Zurich Investments for over 30 years, a long time. But I was going to start off today, but I'm going to talk more about international markets rather than the Irish market. The Irish market, I'm sure, will be discussed later on. But there's been obviously a bit of a bloodbath in the markets this year. Equities and bonds, in fact, government bonds have been hit harder than equity markets. So it's across the board. We've also had a big move in the euro dollar rate, i.e. the dollar has been very strong by about 15–16% versus the euro. So there's a huge amount of volatility in the markets. So what I was proposing to do was to talk about the past, the present, and the future as regards financial markets. And I want to put things into context about what's happened this year in the markets. We have just had a 13-year bull market in equities. So what I did was I just looked at the markets when they bottomed out, well, almost before they bottomed at the end of 2008. So you'll all remember there was a mega crash, the great financial crisis of 07, 08, and early 09. Where the markets were hit pretty hard. But if you had invested, if you'd had this amount of money, if you'd invested 1 million euros at the end of 2008, and that's 2.5 months before the crash ended, the markets were very weak in the first 2.5 months of 2009. But if you invested at the end of 08, 1 million euros, and you'd sold out on the last day of last year, 2021, that 1 million euros would have turned into 5 million euros if you'd had invested in the US stock market. And of course, the US stock market was the strongest, primarily because It has more technology companies, and those technology companies were very strong. You know, obviously the Microsofts and all the rest, Amazon and so on, Netflix. So, you know, it was one of the strongest bull markets we've ever seen in the last 13 years following the great financial crisis. And it's comparable, for those of you who can go back to the bull market in the 1990s. So we have to put this into context. You know, the US stock market is down so far this year about just over 20%. Europe's not far off it. UK's held up much better because it has a lot of energy and mining stocks. But the markets are down, you know, let's call it 20%. But they were up 27% last year. They were up a lot the year before. So in context, yes, we've had a somewhat of a bloodbath in equities. But it has to be put into context that a lot of money has been made in the last 13 years. So before I look at what's happening at the moment, or what we think is happening at the moment, just want to look back and see why were markets so strong in the last 13 years. And when you look back, and certainly at Zurich, we were what we call overweight equities in our multi-asset funds. So we had a lot of equities. It was, you know, fairly, I wouldn't say it was obvious, but it was, you know, there were a lot of tailwinds helping equities in the last 13 years. And let me give you some examples of what those tailwinds were. Firstly, we had low inflation. You know, inflation was down at the target around the world of around 2%, and it had been there for 40 years. And I'm going to come back to inflation, obviously, in a moment. You know, those tailwinds were low inflation, very low interest rates, which Sean was talking about a short while ago, reasonable GDP growth, strong earnings growth, valuations on price earnings multiple terms were fine. We had that quantitative easing, and the relative value of equities over bonds was very clear. So equities were yielding, you know, the earnings yield was about 5 or 6%. Bonds in Europe were yielding 0 or minus numbers. So equities looked much better value than government bonds. So we had all these tailwinds pushing equities higher and higher. And that's what happened in the last 13 years. So I might just put up a chart, a 30-year chart, if I could, please, Sean, for 1 second, just to show you that bull market in the last 13 years. Okay, so I'm not going to say too much about what the difference of the lines are. The top one, it happens to be a Zurich fund, a multi-asset fund, and the blue line is the average fund manager. It doesn't really matter. The point here is that you can see there from in the middle of the chart around the start of 2009, or it was the 9th of March 2009, in the middle there, you see the crash, the great financial crisis. And then you see pretty much 13 years of huge growth. And these funds are a mixture of equities and bonds. They'd be sort of roughly, you know, 2/3 equities, 1/3 bonds and cash and so on. But you can see there the huge bull market following the great financial crisis of 07-08. There was a brief, very sharp decline in February, March 2020. That was the start of the pandemic, when people were freaked, and there was a big fall in the markets. But then it went straight back up again. And on the very right-hand side, you see, you know, some of the crash or correction, the bear market we're experiencing at the moment. But put into context, you see these kind of funds, these multi-asset funds, keep going up. They have their problems. There could be more volatility to come, and I'll talk about that shortly. But you can see there that the markets keep going up. There are crises over the years. You know, we had the dot-com bubble bursting in March 2000. Looks like a blip at the now. We had the great financial crisis of 07-08. We had that brief pandemic fall in March 2020, and now we're experiencing a bear market based on high inflation. So that's just want to put that into context before I talk about what's happening at the moment. So if I could go back, maybe Sean, just to show myself again. I'd probably prefer to look at that chart than look at me. Thank you, Sean. Okay. So I hope you can all see me. Okay, so that's the past. We've had a fantastic bull market in bonds as well, but particularly equities over the last 13 years. And now this year we have walked into an entirely different situation. Instead of having tailwinds behind the markets, we're now facing headwinds, which we haven't experienced for many years. And the first one is inflation. This is the key one, as we all know. And Sean, I'm going to ask you to put up my last slide briefly, just to put things into context as to where inflation is at the moment. And then I'll talk for the rest of my presentation. Okay, thank you. So I mentioned earlier on that inflation has been around 2% for the last 40 years, up till about 18, 20 months ago. And central banks have managed to maintain inflation at that level. In fact, at one point a couple of years ago, we were more worried about deflation, which is negative inflation, which is pretty disastrous as well. But they've kept it at 2% very comfortably around the world. And that's the target everyone wants. A little bit of inflation. You don't want zero inflation. You want a little bit of inflation, but not too much. It's been kept at 2%. I'm just showing you here sort of the last 12 months of figures from the US. So it's moved pretty rapidly in the last year and a half, 2 years, from 2% up to a high point there of 9.1% in a couple of months ago. And now it's beginning to come off, but very slowly. And this is the reason why the markets aren't happy, is that they expected the inflation number in the US and globally to fall much more quickly than it did. Briefly, why was there high inflation? Well, we all know the answer: supply chain bottlenecks. We had massive increase in oil prices, albeit from extremely low levels. Some of you might remember the oil price about 2 years ago, which was hovering around $20 a barrel. Actually fell to $0 a barrel one night, unbelievably. But it went from 20 up to about $125 a barrel over the last 2 years. That's very inflationary. If you come from a very low base up to a very high number, that's a sort of a six-fold increase in oil prices. That's very inflationary. Now, oil prices have come down quite significantly. If you look at Brent, it's currently trading this morning about $90 a barrel. It had got to 125. So oil price seems to be coming off. The natural gas price is more difficult. So oil can be controlled by agreeing with the Saudis to churn out more oil. The natural gas one is obviously more dependent, particularly in Europe, on the Russian situation, which we all know about. But the inflation rate is expected to come down. The futures market are looking at about 6% inflation in the States in about a year's time, and about 3%, 3.5% inflation in America in about 3 years' time. So the markets are looking at this inflation rate to come down. It will be achieved by a reverse of the base effect. So you'll be coming from a high level of oil prices. As they fall, that's very deflationary. The supply chain bottlenecks seem to have been worked out. But the other problem, of course, is that we've had quantitative easing for many years, which is, in layman's terms, the printing of money and the buying of bonds, which finds its way into the equity markets and the economy. So, people thought that originally that quantitative easing would be inflationary, and then everyone convinced themselves that it wouldn't be. And maybe now it's beginning to come through that a huge amount of money created in the economy is causing some of this inflation. Nevertheless, the markets believe that inflation will come down. If it doesn't, if it stays stubbornly high, you should expect further volatility in the stock markets. So just remember that number of 9% there you see on the right-hand side. So I'm going to put that into context, into history. So if I maybe come back to myself, Sean, please. Okay, thank you very much. Now, I'm going to talk about other problems for the markets in a moment, but clearly inflation is the key one. And we've got to look back in history to see what happens in periods of high inflation. Now, I'm going to talk about the 70s. I was around in the 70s, around the 60s. I do remember some of the economic history of the 1970s, even though I was reasonably young. at the time. But some of you might remember back to the first oil crisis in 1973, when it was due to the Yom Kippur War, which was to do with Israel. The West supported Israel. Saudi wasn't happy. They put an embargo on oil to the West. The oil price shot up, and inflation in America rose to about 12%. The second, so we're at 9 was the peak in this cycle. 12 was 1973. Then we had some recovery, and then we had the Iranian Revolution in 1979. And again, the oil price spiked dramatically, and inflation in America rose to 14%. So they're the kind of two benchmarks we should think about: 12% in 73, 14% in 79, 80. And of course, during those periods of high inflation, it's really bad for everybody. It's bad for pensioners, it's bad for investors, it's bad for pretty much savers, it's bad for everyone, maybe except people who borrow money, because if interest rates stay lower than inflation and your salary keeps rising, you can kind of inflate your way out of your debt. But apart from that scenario, inflation is bad. And what happened during that period was very few assets rose in real terms, after inflation. Equities did okay, but when you account for inflation, they didn't. Bonds did very badly. The only thing to hold up during that high inflationary period in the past was gold, which is seen as a hedge against inflation, albeit I wouldn't be recommending putting all of your money into gold. It's just a lump of metal at the end of the day. And the other thing to hold up, if you're interested in this, was farmland, which held up well during periods of high inflation. So what happened was, in 1981, Paul Volcker was put in as chairman of the Federal Reserve. He took drastic action by shoving up interest rates, which at the time were 11%, would you believe, which is way higher than obviously where we are now. And he put them up to 21%. And it was very dramatic. And some of you might remember the early 80s and the very high interest rates. And there was a recession in the early 80s for 2 years, but he got inflation down to 3% pretty quickly. And that's kind of what's happening at the moment. We're seeing central banks pushing up interest rates aggressively, nothing like the early 80s, but certainly interest rates are rising to try to get inflation down. And inflation will come down either by central bank action or the reverse of those base effects I was referring to earlier on. So we have now these headwinds rather than tailwinds. The first one is inflation. The second one is obviously interest rates, which are rising dramatically. The third worry is we're now worried about GDP growth, which is going to be very muted next year globally. Ireland may well get through it for various reasons, foreign direct investment and so on. But I'm sure that will be talked about later on. So there is a worry about recession. The current forecasts are for very low growth next year, but it could turn into recession if interest rates are pushed up high enough. So really there's a balancing act here between getting inflation under control without pushing the global economy into recession. And that is the problem. And markets are, volatile because they're not sure as to what's going to happen, whether inflation can be brought down without going into recession. That's really what the markets internationally are thinking about. Obviously, other worries are, once GDP growth falls, earnings growth falls, and also the opposite effect now, because bond yields have risen dramatically around the world, bond equities are no longer attractive relative to bonds. So if we look, say, at the US 10-year bond yield, which was kind of, 0.5% at the bottom of the cycle, it's gone up to about 3.8%. In Europe, we've gone from in Germany from minus 0.9% 10-year bond yields to 2.1%. So we've had a kind of a 3% rise in bond yields. We're having pretty sharp rises in short-term rates. But if you look at the bond yield in America, 3.8%, that's beginning to look attractive relative to equity yields. So that kind of big argument that equities were better value than bonds is kind of going. So those are the kind of the headwinds we're facing at the moment, and that is why markets are so volatile, and they're likely to remain volatile, in our opinion, until we get better news on the inflation rate. That comes out at 1:30 Irish time on the 10th of every month, unless it's a weekend. So we're kind of about 2 weeks away from the next inflation number. If it doesn't fall much expect equity markets and bond markets to feel a bit of pain. If the inflation rate does fall sharply, we might get a temporary rally in the markets. So it's pretty rough at the moment. Certainly at Zurich, we've been taking remedial action to try to protect our funds, albeit in a difficult environment. So that's the present. It's difficult, it's volatile, but what about the future? Well, we think that if the markets see inflation beginning to fall sharply, that would be a positive. The valuation of equities are now very attractive. I mean, the price earnings multiple in most of the world is around 10, 11, 12 times forward earnings, which is pretty attractive. America is always a bit more expensive. It's about 15 times earnings. After every slowdown, you get a recovery. And, there are some things to be positive about into the future. Earnings will recover. Earnings are remaining, profits are remaining quite robust at the moment. Valuation's good. There will be a recovery. Inflation will come under control. And in time, people will regain their confidence and go back into the markets. There's an old saying we have is that it's always darkest before the dawn. And it's certainly fairly dark at the moment. I don't think we're out of the woods yet. But I think that when we see inflation come under control, markets will begin to recover. So we're not negative on equities in the longer term. We're quite positive on equities in the longer term, but just in the short term, it's hard to know when the volatility is going to end. So briefly, I'm nearly done my 20 minutes. Certainly at Zurich, we're active fund managers. We're trying to move our portfolios around to as we see fit, to looking at the macroeconomic picture. We've outperformed, as you saw in that 30-year chart, we've outperformed by about 2% per annum for 30 years, not every year, but on average. And we've gone through many crises in the past. I mentioned, I didn't mention it, the Asian currency crisis, dot-com bubble, great financial crisis, pandemic, inflation crisis. We always have these crises, and we try to navigate our way through them by actively moving around the markets into different assets, different countries, different sectors, and so on. Final thing I want to talk about before I finish, I think I've probably talked long enough. Responsible investing is very important to us at Zurich and to every fund manager, and every investor should be obviously concerned about this. So we have two mantras at Zurich. One is to do well and to do good, and that means we want to give good investment performance, try to do better than other fund managers, and we try to do that in a responsible fashion. So we engage in responsible investing, and our competitors would I'm sure say the same thing. But passive fund managers find it a little bit more difficult in this area because they have to buy the whole index, whereas an active fund manager like Zurich can be more selective. So we engage in responsible investing in a number of ways. We do impact investing, where we take our own shareholders' money and invest in projects. We exclude certain parts of the market, not many. We're involved in voting in all the AGMs of companies that we invest in. We're involved in a number of global networks promoting responsible investing. And finally, we are fully integrated into ESG investing, and environmental, social, and governance issues, and we take into consideration the ESG rating of every company we invest in, and we tilt our portfolios heavily towards higher rated ESG companies rather than lower ones. And finally, the regulation coming from Europe as regards this area is what's called SFDR, Sustainable Finance Disclosure Regulation, which is coming in very fast into the industry. And what most fund managers in Ireland, whether they're Irish or international owned, are moving towards what's called Article 8 funds, which is that they are fully integrated into ESG. We are fully integrated into ESG. We will be declaring Article 8 status very soon. We're just making sure that all our I's are dotted and T's are crossed, because the regulator hasn't given full announcement yet as to exactly what they want, and we're waiting for that before we declare. But look out for that. It's called Article 8 funds. It means that the fund is fully integrated into environmental, social, and governance issues. So that's it for me, Sean. I hope I haven't gone over time there, and obviously there might be some questions either now or later on, and I would attempt to answer questions as long as they're not too hard.
Sure, great. No, thank you, Richard.
Right.
Given the extreme volatility in financial markets so far in 2022, it meant you had extra interesting information, subject matter, and thank you for presenting it so perfectly. So thanks again, Richard. So over to our next speaker, Brendan Tuig, Chartered Tax Advisor with MK Brazil Chartered Accountants. Brendan has a well-earned reputation for always being interesting, no matter what the subject matter is. I've heard many tax advisors speak over the years, and I can safely say Brendan is the only tax advisor I've listened to who leaves the crowd wanting more when he's finished. So with that, Brendan, the stage is yours. Thank you for being with us today.
Thank you, Owen. I'm just going to share your thing here, so you might confirm to me where you can see them up.
Yeah, perfect.
Are we in business?
In business.
So I'm going to talk about the budget yesterday. You can see all those flicking through there, yes?
Yes, perfect.
Okay. So I'm just going to talk about the budget yesterday in the context of just picking up where Richard left off, in the context of what it's going to do for the next couple of years and the impact it might have on some of the decisions we're going to make. The only way you can kind of do that is by going through a whirlwind tour of the context, the changes, and what we might see going forward. So, and I'll stop and slow down at certain parts I think are worthy of further exploration on your own time, for want of a better phrase, okay? So, as I said, the first point always when it comes to a budget is you have to start with, is my screen frozen there? Can you see me, yeah? Okay. So you have to start with the context. What was the environment? What was the stated objectives, etc., etc. I'm going to start with a very simple one, which is the underlying desire of every political party, not just those in power, but everyone I've ever heard talking to, about making Ireland a more progressive tax system. And if you want to look at the black line there is the target, so that the more you earn, the more you pay. And the lines above it are where we actually are. One of the big problems in Ireland, of course, is we hit the top tax rates very quickly. No one thinks that's a good idea, and we're trying to harmonise that slowly but surely. My problem, of course, always is that there's 3 lines and not 2 lines, because we have 1 line for self-employed, 1 line for POE people, and I've never understood why self-employed people pay a higher rate of tax than employees. I've never understood it because, again, all the political parties think it's a bad idea, yet somehow we still have it after over a decade. So that was the first, we say, general theme of coming into the budget. Were we going to make the system slightly more progressive? Then you had the Commission of Taxation and Welfare. We've had a tax commission report before. Well worth having a look at this if you've half an hour to spare. I'll summarise it quite simply, because they're the same reports we get all the time. 1, we need to broaden the tax base so that more people are paying more tax on more things. 2, we need to do that by bringing more things into the tax system and getting rid of some of the reliefs we have, whether that be curtailing reliefs for family businesses, or whether that be moving some of the low rate VAT items into the high rate VAT items, or just getting rid of some of the reliefs and exemptions altogether. Also, PRSI has to be expanded. And in the middle of all of this, we also need to simplify our tax system and modernize it, because a lot of our incentives fail because they're too complicated, and you have to hire a tax consultant, a solicitor, an accountant, and sometimes a scientist to help you get those reliefs, and therefore they become pointless. So that's the general thrust of the tax commission. More people pay more taxes more often, etc. Right? And that's always the situation. Then you had on foot of the pension side of that report, Minister Humphreys coming out talking about a fundamental change to our pension regime, which will basically involve maybe getting your pension a little bit later, maybe being allowed to contribute until you're around 70, not compulsory, but giving you the option. Not just in the public sector, but they want in the private sector. A lot of people have built-in clauses that they retire at 66 and they want to move that to 70 without denying them the option of going at 66. All this kind of stuff, more PRSI again, getting rid of some of the exemptions, etc. The underlying message here is more. The big problem is the more things to be targeting the self-employed system. If you're Class S at the moment, your own business, you're paying 4%. If you're an employee, you're paying 3 or 4%, and your employer is paying 10, somewhere between 8 and 11% for you. And they want to harmonize those by bringing the self-employed up, which would push sole traders and maybe even directors at 10% PSI, given that they're already paying 55% in income tax when everyone else is paying 52. That would, if that were to happen, you would have employees paying 52 and self-employed paying 60+%. So just keep an eye on that and what's going to happen going forward. But again, the bottom line is we need more money coming in, and we need less people getting our pensions, and we need to change the age environment of the country, right? The scaremongering here says in 2050 we'll have 2 workers for every retired person. That obviously can't happen. The country wouldn't function like that, but I don't doubt the maths involved. And then we had the day itself when the ministers came out and told us that this was a cost of living budget. It had to be a cost of living, was this, right? They had no choice. Again, these are their quotes and not mine. And they touched on what Richard was talking earlier about inflation being exceptionally high, et cetera, et cetera. Again, I'm not an economist, but I don't remember the cure to inflation being to throw once off bag loads of money. I also don't remember the cure for being short of cash is a once off bag load of money. But there was a lot of focus grouping gone into this budget. I also mentioned Brexit, COVID, Ukraine, climate change, and stressed that these were unprecedented times. But lads, they're always unprecedented times, right? Richard just gave you a lovely whirlwind tour of how different things throughout history have impacted on the world. Because, you know, quote a famous song, it is a small world after all. There's no war in any country that doesn't lead into our economy somewhere. So we can't always have the excuse that these are unprecedented times. They're always unprecedented times. Do you know what? When they're not, we have a real problem. That's called a time loop. And then only Captain Picard can help us, okay? So the 11 billion was split between 7 and 4, the 4 being once off. The explanation for 4 being once off is that large amount of our tax, somewhere between 10 and 13% of the tax we collect every year can be traced back to 3 companies or to 10 companies. That's not just their corporation tax, that's also the tax their employees pay and VAT and so forth. So they don't want us to become dependent on what could necessarily be regarded as a flight risk. Now, look, there's a whole conversation here, but I think it is worth noting that the year after we finally admit that we're going to have to revisit our corporation tax regime, we also start talking about the fact that some of our larger foreign direct investors could be flight risks. So, of course, that's not what they're saying, but it's just coincidence that they're suddenly been coming into the conversation. So that's the context of going into yesterday's budget. Did they achieve any of those things? That's for other people to say. I do need to mention a few things just in the context of what's going to mean for the people listening going forward. The bottom line is, in terms of whether you're better off or worse off, everyone listening is better off from a tax point of view, somewhere between 4 and 20 euros. That's a week. That's the bottom line. How we get those figures is boring enough. But there is, this is where we should relabel this discussions about inflation, because this is where inflation comes back into our conversation. Owen will remember, I don't know if Sean was there or not, but Owen will remember I do a budget presentation in Cork every year. And I remember we were down in Little Island back in 2011 when we started tampering with our tax bands. And it was a temporary reduction. At the time, our tax band was 36,400. And I said, lads, you have to understand temporary doesn't mean what you think it means, right? And it will be 10 years before we get back here. And Jesus, I was wrong, right? Because we're 12 years, we're still not back there. Okay, so 36,000 and we're at 40,000 now, but you have to take into account inflation. And in very simple terms, in today's money, 36,400 in 2010 is 42,500 now. So we're still not back to where we were. Now, I want you to remember those numbers because we're going to talk about later on in capital gains tax point of view about how we continue to ignore inflation, which is wrong. But at the end of the day, just to make it clear, I'd much rather the fact that they have put us up to 40,000 than they didn't do anything at all. We all have slightly better tax system now if you happen to be lucky enough to pay tax at the marginal rate, which actually very few of the country is, but very few of those the people who are paying it do tend to pay the bulk of the taxes. So any relief is welcome relief. All the core tax credits went up 75 euros. The home cares went up by 100 euros. The rent credit, 500 euros. We did have a rent credit, right? I never fully understood why we got rid of it. Now I don't fully understand why we're bringing it back. I just want to flag two things about this. One, it's available for 2022, right? There's 2-3 things in this budget that are quite unusual. 99.9% of the time when someone announces change in the budget, it's for the following year.
Brendan, can I interrupt you there saying the slides were, if you could make the slides you're working on bigger, because we're still stuck on the effective income tax versus income level slides.
Really?
Yeah.
So the only way that's showing us to stop sharing and go back in again, is it?
Move down the slide.
Yeah, move down the slide.
Is that moving for you now?
Yeah,
it's
it
moving
is.
on my
I
screen.
can see that moving. Yeah.
Okay. So the thing to remember about the rent credit is it's available for 2022 onwards. So you can't claim it at the moment. You can claim it retrospectively next year. That's unusual. I think there's 3 things in this budget that are applicable for this year, which is very, very unusual. And that's one of those, right? The other thing about rent credit, by the way, is when you look at the documentation, it talks about people renting their homes as opposed to renting a property. Why do I mention that? Because a lot of us would have people who might be renting while they're in college, and it's unclear as to whether that would count for rent relief or not. So just keep an eye on the small print when it comes out, okay? The tax band went up because the minimum wage went up. If you go back to the opening things about the context of this budget and harmonizing, making the system more progressive and dealing with the underfunding of PRSI and so forth, you can see footprints of that in some of the changes, so increasing the tax bands, etc. When we increase the minimum wage, we always do 2 things. One, we increase the band 2 of USC, and 2, we increase the PRSI band to make sure that people on the minimum wage pay the lower rate of USC and pay the lower rate of PRSI. There was no mention of the PRSI change yesterday, right? 2 days ago, and I didn't see it in any documentation. So it might be the start of the change where people are slowly drifting into higher rates of PRSI, including those on minimum wage. So from that point of view, it was interesting. The farmers, various bits and pieces about capital allowances for storing slurry, what they refer to as modernizing slurry storage facilities, which leads me to wonder what kind of systems do you have? Have they a wooden shack out the back that they're putting the slurry into that they need to turn into steel or something? I was going to ask, and I said, you know what, I might want to know the answer to that question. The big change for farmers is actually the reduction in the flat rate farm addition, because that's going to be a reduction in their gross income. So the rest of the stuff is just extending and so forth. Now, I'm going to slow down a little bit about this, because this is important, not from an investor point of view, but maybe from what you're doing with your money point of view, particularly if you're thinking of buying a holiday home. There's a carrot and a stick. The carrot is, if you've got a vacant property and you want to put it back into the rental market, you're kind of caught in a catch-22, because you won't get relief for renovating it until you rent it, and you can't rent it until you renovate it. So they brought in a relief last year and they've enhanced it this year. They're saying, look, if you have a property empty for 6 months, you spend 10 grand and getting it back into the marketplace, then we'll allow you to claim the pre-letting expenses. That's the carrot. No, there's a few flaws with that I won't bore you with, but it's one of those ones that sometimes has the opposite effect, where you're sitting on a property to wait for the 6 months to pass before you put it back into the market and so forth. The other one, which came out of nowhere, is the vacant home tax. And that basically says that if you have a property that's empty for 12 months, you're going to have to pay a new tax. Is coming in next year. It'll be on ROS, it'll be self-assessment. It'll be like your LPT return. If you had to do that this year, you'll have to go online, upload a return and pay a tax. You're sitting there thinking, that's not going to be a problem for me because I have a second home that's not vacant. I don't think you should make that assumption. It's entirely possible you'll have to file a return to say that you don't owe the tax, because the revenue love their data capture. The rate of tax is quite high. It's going to be 3 times your LPT liability. And they define vacant as being unoccupied for 12 months, and they ignore periods of less than 30 days of occupation. In other words, holiday homes. Now, look, there's a whole conversation we can have about that. If you stay there for 31 days, you're out the gap, because I can solve all my clients' problems by taking over the holiday homes for the 3 weeks they're not using it. So it's going to be very interesting how this pans out. But for me, it was interesting from the point of view that it's another tax return, another tax system on ROS. And to quote Field of Dreams, they're not building this so they won't come. The tax take from this is ridiculously low because they keep saying they don't want the tax, they want the stick to put you back into the market. You don't build a tax system unless you're going to be there long term. USC was temporary as well. There's people on this who don't even remember USC being introduced. As a matter of fact, USC is probably older than some of the people that are listening to this. So temporary doesn't mean what they think it means. I just want to mention residential zoned land as well, because if you're sitting there thinking, and that's land banking, I don't have 14 acres of development land in the outside of Ballincollig or Frisborough. No, but if you have a big garden, you probably need to have a look at this. So the maps will be issued on the 1st of November by the local authorities. You need to go in and have a look at this and see, do I have a big garden and am I in a zoned area? Because if I am, you could be liable to this tax, or you might be able to get your part of the garden unzoned, for want of a better phrase. So just don't assume that doesn't apply to you, right? I'm going to slow down again because of the business owners small benefit scheme. Some of the people here remember the old days. This used to be called the Christmas voucher scheme, and it allowed you to give your staff a voucher every Christmas, provided it wasn't cash, provided it was a voucher, you didn't have a BIK. That morphed into the small benefit scheme. There's a lot of flaws with the small benefit scheme. One of those flaws is it's not actually the first 500, it's just the one up to 500. So if I gave Sean 500 euros, it was exempt. If I gave Owen a bar of chocolate and then later I gave him 500 euros, the whole lot was taxable because I'd wasted my one go with the bar of chocolate, right? So you've one go, and this comes up all the time with people having birthdays and things, and they get flowers and all this, so you just want to be wary of this for the accountants who are listening in. It's not the first 500 of benefits, you get one benefit that's ignored. Now, what they've done is they brought in a new rule that said you can do two of them, and the cap is now 500, it's going to be 1,000. The idea being, if you want to give your staff 500 euros now to help with the cost of living, and if you want to still give them the 500 at Christmas. But this actually could solve a lot of problems for some of our employers. Like if you take any, I know running a business, I'm running a business, my ESB bill has gone from 2 grand to 10 grand. All my materials have gone up 8 or 9% because of Brexit and the Ukraine and so forth. And cash is killing me. But in the meantime, I've Sean and Owen working for me, and they're great, and they can't afford to pay their ESB or their mortgage and all that. They're saying, look, I need extra money. And I need 1,000 quid. Here's the problem. For me to give him 1,000 quid, it's going to cost me 2,500 between taxes and PRSI and the whole lot. And I could probably scrape 1,000 quid together. I can't scrape 2.5. I certainly can't scrape 5 to give the two of them. So this might actually give people a little bit of a release. You can come into Christmas, look, here's 1,000 quid. It's once off. You're not committed to increasing your wages. It'll buy you a little bit of breathing space to get you into next year. Technically, this can't be salary sacrifice, but you're not sacrificing anything because you haven't given it to them yet. But I just think for a lot of employers, this might give you an opportunity to kill 2 birds with 1 stone, and that you'll be able to ease your staff existing problems without killing you from a cash flow point of view. The big news, as far as I'm concerned, is there's still no change to the closed company regime. This is a big problem. We did a presentation on this, and I showed how a company purchasing investments.
Brendan, yeah. Sorry, can I ask you a question there? Just about the small benefit scheme, was 500 now 1,000 and 2 per year? Is that 2 by 1,000 per year? Or I know this sounds greedy, or is it 2 being in total 1,000 per year?
No, you can, it's two benefits and max 1,000.
Okay, thanks.
Right. And as I said, that's going to actually help a lot of people, because if you did buy someone a box of chocolates or flowers during the year, you're not shot now. You can still do the second one. That's the big advantage of the 2 benefits. Here's the problem with closed companies. We did a presentation on this, and I showed how a company with money can invest in something, pay the 25%, pay the surcharge of 40%, then pay 50% to get it out, then pay 33% to get to the children. And to travel from your investment to your children's pockets, you could actually lose 90% of any yield in taxes. Now, you shouldn't because your advisors and accountants will be helping you, but it is possible. And there's something fundamentally wrong with this. Ireland doesn't have a 12.5% corporation tax. Ireland has a 12.5%, stroke 15%, stroke 20, stroke 25, stroke 40, stroke 56.5% corporation tax if you're not careful, right? So we've talked about this at length. Sean and Owen know with this. This needs to change. I don't know why we discriminate against small Irish family companies and why multinationals can, pay 6% tax on their rent and we're paying 40% tax on investments and rent and so forth. But while it's not there, you kind of need to consider the logic of investing in a company when you can invest the same money through your pension, right? So rather than having 100 grand in my company going into an investment where I'm going to pay taxes all the time, take the 100 grand, put it into my pension scheme and let it invested in there. Because if my investment goes up 10 grand, the taxman is going to take 4, I'm left with 6. So next year's investment won't go up 10, it'll only go up 8 or whatever. If that's in the pension fund, it'll grow tax free. So while our closed company regime and our corporation tax regime frowns upon passive income, you kind of really need to think about using the company pension scheme as your main investment vehicle. I'm not saying you have to do it, I'm just saying you have to at least consider it, right? I'm also going to mention the Keep scheme only in passing for anyone here who's an employee or is in a company with a lot of employees in it. The Keep scheme was introduced to a lot of fanfare, has been a clever way of incentivizing staff to stay and to remunerate them tax efficiently. It was never going to work when they brought it in because it was just too complicated and there was too many restrictions. Two of the biggest problems were that you couldn't get the staff back out after you gave them the shares and that there was no clear rules about valuations. They promised that they're going to revisit this, especially on the redemption aspect. So all I'm saying to you is, will you put this into your diary to have a look at it next January when the legislation has been passed and see if we now have something that's actually worth having a look at. The other big thing that came in is the temporary business energy support scheme. This is borrowing on the concept that they had in relation to the EWSS and the wage subsidies, where they contrast 1 year's cost with another year's cost and give you a subsidy based on it. Now, again, we know very little about this. To qualify, he mentioned specifically case 1 businesses, which should always be an alarm bell because case 1 tends to mean they're going to exclude a lot of businesses like accountants, solicitors, professionals, and so forth. He also mentioned tax compliant, which again is just an alarm bell because that might mean you need to have an electronic tax clearance certificate, which you won't get if you have certain debt warehousing problems and so forth, which a lot of people have post-COVID. And he mentioned that you must have a 50% criteria where this year's bill must be your 50% last year's bill. I'm very confident that's true, just based on the fact that my own home ESB seems to be going up 150% every 2 weeks. So I have to imagine companies aren't running their businesses cheaper than I'm running my house. So hugely important in that it will be free money. It's probably one of those you want to look at yourself because it looks like it's going to be time heavy because there's going to be a lot of stuff need to be uploaded onto Ross and so forth. Your accountants will do it for you, of course, but there's no point in paying him 2 grand to get back 5 grand. But well worth having a look at. We'll know more when the legislation is published. And the last thing I want to actually slow down on is the the defective concrete product levies, what they call it. I took out the word defective because it's misleading. This is just an extra 10% charge on concrete products at the point of sale, which basically means a 10% increase in the cost of construction. Now, I was talking to a builder the other day. He's doing an extension of an office block. He said he just poured 70 grand worth of concrete into it. And of course, that's going to be 77 grand next year. And he's not going to pay for that. Someone else is going to have to pay for that. So you throw in the cost of materials, you throw in the increased cost of labor, and then you throw this 10% on the top of it. It's going to get more and more expensive to build anything. That's the long and short of it. So the VAT 9 is extended to February and then it's gone. So all the hotels are unhappy about this and so forth. CGT, no change to CGT. And this is where I want to go back to the earlier slide. If I bought something for 36,000 back in 2010 and I'm selling it now for 40,000, it looks like I made money, but I actually didn't. I actually lost 2,000 euros on that transaction, but somehow I'm still paying 33% tax. Never made sense to me. These politicians are very fond of telling us what everyone in Europe is doing, and we shouldn't be any different until it suits them. Like, most people don't tax on money they don't make. I'm funny like that, right? Whatever what the rate of tax you're paying your income or gains, you shouldn't be paying tax on money you're not making. Indexation was temporarily suspended again, temporarily 20 years ago, and it's supposed to be out constantly on the agenda, and there's no sign of it coming back. No changes to CAT, which I'm very frustrated about. And this is what we call managing expectation. They planned the story in the Irish Times the week before the budget that they're looking at culling the thresholds and increasing the rates. Trust me, they're not culling that threshold. Right? They were never culling that threshold. As a matter of fact, they've committed to going back up to 500,000 euros. And instead of us all being angry and frustrated, we're now relieved. And we shouldn't be. We shouldn't get tricked like this. There is one disturbing thing that's starting to do the rounds through the Commission's reports, and that's about the fact that they don't want any thing as an exempt gain. In other words, the revenue are mad to get the information. So if you're giving 2,000 or 3,000 euros to people, or you're buying someone a box of chocolates, they want you to submit that somewhere so they can monitor it, right? So just watch that space. That won't come out now, but that can be hidden in the finance bill in the time to come. What it means for us is, in the short term, you really need to take advantage of the stuff that's on the table. I've worked with Owen and Sean in the past. We have had guys, their grandson is born, and the first thing they do is congratulate the mother and father, and the second thing they do is ring us, and we put them into some kind of investment product where they put in 500 quid a month over the next X amount of years, so that when the son or grandson or granddaughter is 18, they have their college paid for, maybe a new car, and if there's enough left over to pay my fees, we're all happy. So you really need to be creative and innovative for these things, because they don't look sexy because it's 3,000 euros or 6,000. There's two of them there, but they're very effective if you do it on a cumulative basis. Time is very much your friend when it comes to those things. So just a flag as well, given the nature of our presentation, the Minister also announced that there's plans to review how various investment products are to be taxed going forward. As you know, a lot of these are taxed to source, some aren't, and there's reporting things there and so forth. I have no idea what they're going to come out with on that. I can't imagine it'd be any worse, because at the moment you pay tax either as income, or 33% as a gain, or 41% as source. So it won't get worse. It'll probably be about simplification, I would hope, right? So look, what does all this mean in a nutshell? What it means is you're going to see a broadening of the tax base. You're going to see more wealth taxes. We like to pretend we don't have wealth taxes. We do, we just don't have a wealth tax. The vacant home tax is another example of a wealth tax. We're also going to see a serious overhaul of our pension, our state pension regime, which only emphasizes the importance of having your own pension arrangements in place. A lot more paperwork, a lot more administration, etc. That's what the future holds for us. So I'm getting close to the time. So in terms of what the budget means for us going forward, it didn't really change a lot, as it give us more administration, but it does act as a timely reminder, as I said, not to forget about the food you have on the table. Don't be always looking over the fence at other people's food. And so it's a barbecue scenario in my head. So you have the small gift exemption, you have the Class A thresholds, right? You have a 33% CGT rate, which is better than 52%. You have things that you could be looking at now, and don't ignore them. Don't assume they'll always be there, because they mightn't be. And back to you there, lads.
Thank you very much, Brendan. Really appreciate that. In fact, on behalf of the entire audience who are watching in today, I say a big Gareth Mahagut to Brendan and indeed Richard for their thought, for their contributions, which were both insightful, thoughtful, and colourful. If you want a copy of the slides, or indeed your CPD search, you please email either myself or Owen Buckley. We have on our system here a list of who has attended, and according to the Institute of Bankers / LIA, it is my understanding the rules are that the CPD search can only be used by the live attendees. Now, if anyone has any questions, I don't see any in the inbox or in the question box at the moment, but if there are any questions, please do ask, and I'll ask our speakers. But in the event that we don't have further questions,
Can I ask Richard a question if he doesn't mind?
Yeah.
In my head, Richard, I always have inflation as between 3 or 4%. You mentioned it was 2% for a long period of time. And now, of course, it's gone high. Where do you think its natural home is?
Okay, well, I suppose you're right. I mean, inflation isn't always 2%. I mean, it got in America. We always look at America first because America represents 67%, or North America, I should say, represents 67% of the global stock market currently. So we kind of spend so much time looking at the US because it's so important. But European inflation can be slightly different. But yeah, it moved between 1% and 3% for nearly 40 years. I mean, they've kept it under control very, very well, despite the quantitative easing. But yeah, it does creep up to 3%, and probably you might say they struggle to keep it at 2%, but 2-3% is probably it's where you'd like to see it. I would say. I mean, it is a situation where they try very hard to keep it under control. I mean, the European central bank's only purpose in life is to control inflation, whereas the US central bank, the Federal Reserve, has to control inflation and look at the employment rate as well. Yeah, no, you can argue it's 2 or 3%, but that's kind of I would say the natural home for it. You don't want high inflation, clearly, because it's very bad for everybody, perhaps except borrowers, as I mentioned. You don't want deflation because that causes massive reduction in GDP growth, because people put off spending because they think they can buy something cheaper in a year's time than they can buy it today. So I hope I've answered that your question there. It does move around, but certainly 2-3% would be a very preferable rate for inflation.
When people have a chunk of money in the bank account and they're talking to what they should do in the whole lot, my advice always is, if you're not getting a 3 or 4% return, then that's just to keep up. And that's kind of where we're at, I assume, yeah?
Absolutely. I mean, you heard me talking there about real returns, and that's what it's all about. You're quite correct that, you can say the stock market went up 10% last year, I've made 10%. But if the inflation rate is 5%, you've only made 5%, because, in real terms. And real terms is what it's all about. Just think of house prices in the last 40 years in Ireland, and where they've come from to where they are now. If you had a fixed income 40 years ago, which wasn't inflation linked, you'd be in serious trouble. So real returns is what it's all about. And then we often forget about dividends. Dividends are very important in your analysis of returns as well. So it's not just the index return you're getting, it's the dividend return, which is roughly 2% globally, 1.5% in America, 3% in the States. So it's always worth building into your model as well.
Thanks, Richard.
Thank you. In the lack of any other questions, I would like again to say thanks to the audience and remind you that we'll be uploading this to our website, hopefully today or by close of business tomorrow, and it'll join the video of our 1st of July webinar, which we put up, which we organized quickly when the bear market had been declared in June. We are hoping in early 2023 to run another webinar. Do keep us posted and do keep talking to us. Okay, so do we have a question there? No, Q&A. Actually, I may have a question. So Pierce Whelan, thank you for asking. With increasing in bank lending rates, do we see an increased rate of savings? As in, will deposit rates rise now with interest rates rising? Maybe that's for you, Richard, please.
I mean, I think I sort of made that point, maybe not necessarily about bank rates, but as interest rates rise, it becomes more attractive to put your money on deposit. I mean, banks will be slow to put up deposit rates. With all due respects to banks, they make money on the margin between the deposit rate and the lending rate. But as interest rates rise, it does become more attractive to have your money on deposit or in bond markets. But that doesn't necessarily mean the equity markets can stall. I mean, we know over time that no matter what happens in the world, equity markets keep going up. They can have bad periods, they can have volatile periods, but they do keep going up. That's the nature of the capitalist system, that you must reward risk, and equity is risk, and therefore you must be rewarded in the long term. But certainly as interest rates start to rise, people may well put money they have back on deposit. Now, the problem in Ireland is, and I'm not an expert on the Irish situation, but leave that to Brendan, but we have a huge amount of money on deposit already. My understanding is there's 130 billion euros of Irish client money sitting on deposit with the banks. And that has made no money in the last, even before tax, it's made no money really by having your money on deposit. Now, the equities and the bonds have done poorly now, but you certainly, if you have your money on deposit, in real terms, you're losing 9% per annum by having your money on deposit. At least by putting your money into investments, when the recovery comes, you'll get a sharp bounce in the markets.
So actually, as a follow-on question from that, Tom Purcell is very aptly pointed out that if inflation were running at 12% and investment return is 4%, where will someone get a return of 16% to negate all this?
They won't.
Okay,
That's the problem, and that's why I mentioned. I'm sorry. Maybe you can, if you buy some kind of, take some huge risk on a punt on something, you might. But in sort of amongst the main asset classes, you won't, and that's why inflation is so bad. And that's why I mentioned my looking at this. It's only me, but looking back to the 1970s, as I said, the only assets that gave a real return were farmland, looking at the US, farmland and gold. And it was very hard to get a real return on anything else. But I mean, that's probably you should always buy some. Well, it's kind of a mantra. You should always buy something when everyone hates it, and you should sell something when everyone loves it. And at the moment, everyone hates the equity market and the bond market, and they like gold. So that's just an old mantra, that the time to buy is when there's kind of blood on the streets.
No, thanks for that, Richard. Happily, Brendan, you've got a question too. Dave Sweeney is asking, with nothing essentially in the budget for landlords with full occupancy, what would your advice be to sit or sell?
I was surprised how surprised the landlords were that they got nothing in the budget, right? Because we've been kicking landlords almost consistently for 10 years. Like I always remember saying that the Ireland treated the landlords, after the crash, we treated our landlords worse than we did back in the Land League days, right? Because like they were getting, some people get out of bed in the morning with no money. Landlords were getting out of bed in the morning minus 400,000 or 500,000 and having everyone coming on television telling them they were the problem. So I don't know what happened to landlords that they got their hopes raised. I don't know what they were expecting in the budget. So to me, there's nothing different between this year and last year. What is if you think you're going to go value, you think you're going to keep getting good rent, keep it. If you want out of all the hassle of having to deal with someone about changing a light bulb, or the neighbor across the road was playing the music at 10:01 in the AM, get rid of it. Right? Life is very simple. But the budget didn't. The answer to the question is the budget didn't change anything for landlords. That is true. I don't think that's bad news, because I think that the next change that you're going to have for rental in this country will be that they pay a higher rate of tax as opposed to a lower rate of tax. That's the pressure. The pressure that's coming on government is to tax landlords higher so that they put their properties back into the market, so that Tom and Mary, the newlywed couple, can buy their first home. So I think it's good news there was no change to landlords, because I don't think there's anything positive coming their way. But I missed a meeting somewhere where they were promised something.
Okay, thanks, Brendan, for that fantastic answer. We'll wrap it up now. We're at we've ran 4 minutes over time. Thank you again, and we'll see you at the next webinar.
Thanks, lads.
Thank you.